In this video, I'm going to show you how to read a chart in 3 very easy to follow steps. This is going to work for any instrument that you may be trading, like crypto, forex, futures, options, stocks, it doesn't matter. The principles of price action are going to apply to all different markets. Now, these are going to be the fundamentals and they're going to be the basics. But just because they're the basics doesn't mean that they're not important. It doesn't matter what level of experience you're at. These are always going to be important. This is something that we do every single day as we analyze price. By the end of this training, you're going to be able to look at a chart and understand what is happening and what price can do next. And that is essentially all we're trying to do with trading. If we're able to anticipate what price can do next, we're able to make money. And so let's start with step number 1. Step number 1 is going to be to identify the trends and use trend lines. So let's do that. Now let's talk about a trend first. And what a trend is simply a directional move, whether that's going to be going up or going down. In the diagram here, we have price clearly going to the upside. And the thing to know about trends is that it's not going to be in a straight line. It is actually going to be in a pattern like this, making waves. And so you're going to have in a trend, price making higher highs and higher lows. Higher highs, higher lows. Higher highs and higher lows. That is how you know you are in a bullish trend. Now we mentioned that we move in waves. And so there's 2 parts to those waves. When we're going in the direction of the trend, that's called an impulse. And when we momentarily go against it, that is called a retracement or a pullback. So we're going to move in impulse and retracements. Impulse and retracements. You cannot create like these peaks and valleys. And that is going to be characteristic of a trend. And this is where trend lines come in. And essentially what a trend line is, we're just simply going to connect the lowest points of this upward trend. We're simply going to draw a line across and extend it into the future. Now, a trend line is going to be useful so that 1, we can clearly see where the trend is. And 2, we can project where price can continue to go and at what point we have changed directions. For example, with the diagram, we can anticipate that price can continue doing this. And eventually, once we break the trend line, there can be a potential change in direction. Having a trend line drawn is going to allow you to visually identify those moments. Now let's look at a downward trend. A downward trend is going to be the exact same thing, but going down. In this example, clearly on the way down, and again, not in a straight line, we're actually moving in waves. We're making lower lows and lower highs. Lower lows, lower highs, lower lows, and lower highs. Anytime we're going in the direction of the trend, that is called an impulse. When you have a momentary move in the opposite direction, that is called a retracement. Impulse, retracement, impulse, retracement. Again, we're just watching these waves play out. We are going to have trend lines on the way down as well. The only difference is that we're going to be drawing it across the highest points of the downward trend, like this. And we're going to be drawing a line across it. And again, you want to extend it into the future. That way you can project where price can go. And once that trend line is broken, there's a high likelihood that we are going to change directions, which is why they're important in the first place. One of the mistakes that I see people when drawing trend lines is that, for example, with the downward trend line, I see people drawing it here instead of on the top. And this is going to be key. If you're going up, you're going to be drawing it at the bottom. And if you're going down, you're going to be drawing it on top. All right, I have TradingView open here, and we're looking at the S&P 500, the E-mini futures contract, which is what I trade. And we're going to identify a couple of trends. Again, you can have very big time trends over months, years, maybe weeks. You could also have small trends within 5 minutes, 10 minutes, an hour. Right now, we're looking at the 1 hour chart. And so we're going to identify a couple of trends. Let's start with a couple of small ones here. As we can see, we have a small trend here. We have higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And we're moving in waves, right? Like this. Very, very clear. And we can also see that there's a trend line just like that. So why don't we draw that one out? And I'm going to draw a line across it so we can see it. And we can see that once the trend line is broken, we have a change in the opposite direction. And so we can actually see that a downward trend is formed. We have price moving in waves on the way down. Again, making lower lows and lower highs. Lower lows, lower highs, lower lows, and lower highs. So what we can do once we have identified the trend is to draw that trend line. And I always want to make sure that we draw it on the highest points, right? At one point it was like this, but price passed it over here and it came back down. So I'm going to adjust it to take into account those pivots. Once price broke the trend line, we started a very strong move to the upside. Now, these are very short-term trends. Now let's look a little bit bigger one. I'm going to zoom out and I can see that there's actually a big one here. Over a whole month, we have price moving in waves like this, right? And so I can actually draw a trend line to market. So initially the trend line was like this, right? And eventually price came down, it passed it and then came back up. So in a scenario like this, I like to adjust it to take into account the latest swing low here, the latest pivot. And we had a similar situation here later on. This was, days later. You could always continue to adjust it. But overall, you can see that this is a very big trend. And inside that trend, we have smaller trends that play out as well. The market is going to be fractal, so you can see a big move, and within that move, you have smaller moves that look the same. And within that smaller move, there's other moves inside of that. So whether you're looking at the market in the big long-term picture, or whether you're looking at a very small time frame like 1 minute, you're going to see the same things show up. Once we have identified trends, trend lines, the next step is going to be to identify levels of support and resistance. And the way I like to think about this is if you think of a house, you're going to have a ceiling and you're going to have a floor. With price is the same. When price is trending, it will eventually find a ceiling and a floor, essentially creating a range. And a ceiling is where price can no longer continue going higher, and a floor is where price can no longer continue going lower. And so they're going to be rejection points. So let's take a look at a couple examples here. In the example here, price is trending lower, right? We have lower lows and lower highs. Lower lows, lower highs. We eventually reach a low where price rejects very strongly. This is where you will draw your support. Price comes back to it. It rejects once again, and it changes direction. So this is the floor that we reach. The thing with support and resistance is that you want to also extend them into the future. So if I have this support here, I'm also going to draw it across so that when price comes back to that level, I'm aware that there's a level of support and we can potentially have another reaction. Like anything, this is not 100%, it's a game of probabilities. So we want to be aware of those levels, not to say that we're 100% going to change directions, but that is likely that we're going to have a reaction. That is very important to understand. Same happens with the resistance. In this example here, we're going in the opposite direction and we are trending up, making higher highs and higher lows. Eventually, we hit a level where price rejects. That is when we draw our resistance. Price comes back to it and reject once more to change directions. Again, that is the ceiling that stopped price from moving forward. All right, we are back on the charts of the S&P 500, and we are going to identify different levels of support and resistance. Now, here I have a few, and a very, very easy one to spot is going to be this one, right? We were coming in an upward trend. Price reached this level and it completely rejected. It then came back up to the same area and it rejected. So the first time that happens, I'm actually going to draw that level. And I'm going to use a rectangle and I'm going to extend it into the future. I like to use a rectangle because these areas are typically going to be a small range. It's not going to be an exact price, although it can happen that you have a very specific price and the market actually stops on the tick at that exact moment. But I like to give it a small range. And again, on the first rejection, you're actually going to extend it to the right. And we can see that price rejected here, came back up. It rejected once more and changed directions. Now, where will be the support in this scenario? Well, when price came down here, we have a very strong rejection to the upside. So this is where we draw all support. And price attempted to come here, not quite all the way, but rejected. So in this scenario, I will draw another rectangle, another area right here. And there we go. We have our areas of support and resistance. Now, can there be areas within the areas? Of course. So for example, here, you can see that there is a rejection here and a rejection here and here. So technically you can draw a line across. There was another one here. So you can have this as well. And if you think they're important, if you see that price is rejecting the same price over and over, what you can actually do is I will just draw a line across, a horizontal line just like that, just to visualize it. Something to keep in mind is that it can very easily become too cluttered if you just start drawing lines everywhere. So the best practice is to actually identify which are the levels that right now are the most relevant, which are the levels that have been the strongest rejections, and which are the prices that the market continues to respect. So in this example here, you could delete a few of these and leave the two main levels. Now, something to know about support and resistance is that anytime that a level is broken, there is a high probability that price will come and test it. So for example, here we have a resistance level, right? Very clear. Price breaks the resistance and it eventually comes to test it. Actually tested 3 times as support before continuing higher. So when we break resistance, price will test it as support. And when we break support, for example, if we broke through here, price will typically come and test it before continuing lower. So that is price action 101. And if you can understand that, you can very easily start anticipating what price is likely to do anytime you can identify support and resistance. That applies to trend lines. Sometimes you break the trend line and a lot of times you'll come and test it and continue. In this example, you break the trend line to the upside and it comes and tests it really quickly before continuing. Trend lines are going to be levels of support and resistance. They're just not horizontal, they're just diagonal. Now that you have identified trends, trend lines, you have support and resistance, the next thing and the last thing is to identify any price action patterns. You're going to be able to see visual patterns in the chart that are going to indicate whether we are going to change directions or whether we're going to continue. Now, there's going to be probably hundreds of patterns out there, but I'm going to be giving you 3 that I think if you have them, you're going to be able to make a lot of money. These are the 3 that I actually use every single day and that show up the most. So that's why I think they're so important. So let's start with the first one. First one that I'm going to show you is the double top. It's one of the easiest patterns out there, but incredibly effective. And it's very simple. We have a trend here going up. Eventually, price finds a level of resistance and you have a very strong reaction. Price comes back to the level, and we have a very similar reaction, rejecting that level. What is going to be characteristic of this pattern is that it is going to be in the shape of an M. The two reactions are going to be very symmetrical, and you're going to be able to spot it that way. Anytime you have this pattern, there's a high likelihood that we're going to reverse and change directions. Now, it is important to keep in mind where the pattern happens. Context is everything in trading. And so these patterns are going to be most useful when you're close to an important resistance, where you're close to an important level, and not just randomly a very small pattern that looks like a double top, but the context doesn't really say anything. That is the key with these patterns. Now, these patterns are going to have what is called a neck. The neck is simply a line that we can draw across to connect the base of the M. This is going to be useful because once we break the neck, you can expect price to continue lower. Now let's look at the opposite pattern, which is going to be the double bottom. The double bottom is exactly the same thing, but upside down. For example, here we're coming in a downward trend and we have a rejection. Price comes back to the level again, and we get a symmetrical rejection, creating a W pattern, just like this. And again, anytime you see this pattern, there's a high likelihood that we are going to change directions to the upside. Now, the neck for this one will be right across the base on the top. And you want to pay attention when price breaks the neck, because that's when the move really happens. You want to see these patterns at the bottom of a trend, near a support. That's where they really matter. All right, let's look at a couple of patterns here. Again, these patterns can happen very small, very big. So I'm actually going to delete these trend lines here just to make it easier to see. And I want to point out this really big double top that was forming here. I don't know if you can see it, but price reached this level of resistance here that we talked about earlier. And we had a very strong rejection, right? We came back up to test that level, and we had a very strong rejection. That was trying to look like a very solid double top, right? The M pattern. And so this is actually playing out over a few days. So actually in class with my students, we were talking about this pattern. When we started to see this move here, we were anticipating that we could potentially come all the way down as we complete the second leg of that pattern. And it actually happened. We were able to capitalize on a lot of the small movements in between. So being able to spot the pattern can help you start having a directional bias so that you can line it up with your strategy and find the best opportunities. If I have a very big double top like this, I want my ideas to line up with what the pattern is saying. That way I'm not going against it. Now, of course, you can see that it reached the bottom and it eventually failed to continue higher. But that is just, the way it goes. Doesn't mean that you couldn't make money with it. But it didn't break the neck to continue lower. It just continued higher. All right, now let's look at the opposite pattern, which is the double bottom or the W. I don't know if maybe you spotted it already, but we have a downward trend here. Price makes a new low and it rejects very strongly. Comes back down and rejects once again, creating this W shape, and then it changes directions. I do like to draw the neck of the pattern, so I'm actually going to draw it. You can draw a line across, just like this. Like I mentioned, the neck is going to be a level of support and resistance. So if we break the neck, we can expect that at some point, price is going to try to test it. In this scenario here, we came pretty close, didn't quite test it, but it eventually came all the way here, tested a couple of times, and continued higher. So I always like to draw these necks just so I can keep them as levels of reference in the future. It can be retested in the next 2 minutes, in the next 5 minutes, or the next day, right? You just don't know when, but very important levels. All right, we talked about the double top and the double bottom, but there's a pattern that I really love, and I just see it everywhere. It's my favorite pattern. That is going to be the head and shoulders. This is another pattern that is going to indicate a possible change in direction. And so the way the head and shoulders is going to work is that you're going to have a trending move, right? You find a resistance, you break the resistance, and on a normal trending move, you will come down, test it, and continue higher. Continue making the waves, right? What happens differently here is that instead of continuing higher, you actually come back below that level, failing to continue higher, and change directions. What gives it away is going to be this false break here, the false move, that is going to be the head. The reason it's called the head and shoulders, people say that this looks like a shoulder, the head, and the second shoulder. The neck of a pattern like this is simply going to be a line across the two shoulders. So at the very bottom, and you're going to have the shoulder level, which is going to be the resistance. Same happens on the way down. In the example here, we have the inverse head and shoulders. And again, it's just the same, but upside down. We have a trend going down. We find a support. We break the support. And again, normally you will come test it and continue lower. But that's not what happens. We break the support and we come back above it, failing to continue lower. Come back and test it and change directions. So the neck, again, is going to be at the base of the shoulders. So right on top. And you always want to pay attention on these patterns whenever the neck is broken, because that's when the big move happens. Let's take a look at a couple of examples so you can see what I mean. Back at the S&P, we have a very small head and shoulders here that shows up. And if you can see, we reach a level here. Price breaks it and fails to continue higher. Comes back below. And a lot of times, price will come and test that shoulder level to make it a very symmetrical pattern. We have the neck right here. And eventually we break below. So what I like to do is that I definitely like to mark the shoulder level, because a lot of times price will test that. And I like to draw the neck as well. So I will draw the neck over here. And look at this beauty. We have shoulder one. We have a failed break at the top that creates the head. We come and test the shoulder level. Price breaks the neck to change directions. Comes to test the previous resistance as support. And then it comes and tests the neck of that pattern right here. Twice. Comes all the way back down to test the support. And then it comes above the neck, pretty close to the shoulder level. Now we're inside this range. And we also test the neck once again as support before propelling upwards. And so if you're able to identify these levels, you're going to be creating a map of where price can stop, where price can go next. Very, very useful. Now let's take a look at the reverse of the head and shoulders. Let's look for an inverse head and shoulders here. Not the best pattern here, but we can definitely see it. We have price coming in a downward trend. We find a support here. I like to draw it across. And we have a failed attempt to continue lower. Price comes back above it, and we change directions. So I'm going to draw what the shoulder level will be, and I'm going to draw what the neck will be. And sometimes you're going to have an asymmetrical pattern. So you see that the shoulder is not at the same height. It's actually a little bit crooked like this. So this is shoulder one, and I will say this is shoulder two. And I will say the best line is actually across like this. And we can see that after price fails to continue lower, we come and test it. Then we break and we come and test the neck as well before continuing higher. And so not all the patterns are going to be perfectly symmetrical. Sometimes they're going to be a little bit slanted. Sometimes they're going to be a little bit asymmetrical. My favorite patterns is where they're perfectly symmetrical, super clear. There's no doubts that it's a head and shoulders, a double top, a double bottom. Those are the patterns you definitely want to pay attention to. And the bigger, the better. The bigger the pattern, the bigger the time frame, the more powerful they are, especially as you trade in the smaller time frames. All right, we talked about the double top and double bottom. We talked about the head and shoulders and the inverse head and shoulders. Those are both reversal patterns, meaning that when they happen, they're indicating a possible change in direction. Now, the next pattern is going to be a continuation pattern, meaning that when you see it, there's a high likelihood that price will continue in the direction of the trend. So that is going to be the descending channel. In the first example, we have price going up in an upward trend. And we see that on the pullback, we start creating a channel just like this. A lot of times you're going to be able to draw lines diagonally to mark the channel. And anytime you have this channel, there's that good likelihood that we are going to break the top of the channel and continue the trend. Again, if we were coming from an upward trend, we will continue in an upward trend. Same is the opposite with the ascending channel. We are coming from a downward trend. On the pullback, we start creating what looks like a channel here, and we can use lines to draw it. So anytime you have that channel going up in a downward trend, most likely thing to happen, the price will break below and continue the trend. It's a very, very useful pattern, and this one shows up quite a bit, so you definitely want to pay attention to it. All right, so we're back at the charts of the S&P, and let's look for some channels. I'm actually going to clean this up a bit just so it makes it easier. And I can very easily spot an descending channel. So we have a trending move here. And as price retraces it, you can start seeing a small channel here that is formed. And then price continues higher. So what we can do, most charting platforms are going to have either the ability to draw a line, so you can draw two lines, or you can have some tool to draw a parallel channel. So I'm going to draw two parallel lines here that are going to outline that channel. And again, look how beautiful this sequence of patterns are here. You have a resistance, price breaks the resistance, we create that head and shoulders pattern here, and we start trending down, creating this channel. We reach the previous resistance, we test it as support, and we break the channel to continue higher. We pretty much you saw everything play out in a single chart. We also had this big double top earlier here. We had the support here. We had an upward trend line here. We had a downward trend line here. And all these little pieces come together to give us all the information that we need to be able to anticipate what price can do next. And so that is a very, very clear channel there. Now let's do a couple more. All right. I just found an example on the way down. So we have a very clear downward trend here. And we see that on the pullbacks, that's where you get these channels. They can be big channels, they can be small channels. For example, there's one here. You can see that price is retracing in waves, creating a channel. It is broken to continue lower. So I'm actually going to use the parallel channel tool to create the channel here. Something that happens quite a bit is that, remember, trend lines, channels, necks are levels of support and resistance. So usually when price breaks, it will come and retest those levels before continuing. So you definitely want to have those drawn out. But if you can see, there's also smaller channels that happen on the smaller retracements, like here, like right here too, and right here. So I'm actually going to draw those as well so we can visualize them. Right there. And there's another one smaller right there. And there's another one right here. Really nice. And you're going to have a bunch of little channels like this. The more you practice these patterns, the easier it becomes to see them. Right now I'm at the point where I open up a chart and I see all these patterns, all these setups. I see my strategy very well. It's because I've seen thousands and thousands of these patterns where it just becomes second nature. And so that is what you need to do. You need to go on the charts, practice drawing the patterns, identifying the trend lines, identifying the trends, identifying double tops, double bottoms. People really obsess over candles. I'm not saying that candles are not important, but believe me, you can do a lot without the candlestick patterns and all that stuff. If you can understand market structure, if you can understand what I just show you here, even though it seems very basic, very simple, you're going to be able to do a lot. You're going to be able to decipher most markets because price action is all the same regardless of what it is. And so if we come back here to the beginning, we see that we have used all the different tools that I showed you to analyze what price is doing. We use trends to identify different trending moves inside here. We identified different trend lines. We identified how, when the trend lines were broken, price changed directions. We identified some double tops and double bottoms, some head and shoulders patterns. We identified really important levels of support and resistance. We identified how price, after it breaks a level, will come and retest it. We talked about the channels that get formed as well. That gave us an indication of continuation. And that's essentially how you read a chart. It's very simple. I think people overcomplicate it. If you know the basics, the 3 steps, that's it. That is the foundation. Now, on top of this is where you build your actual trading strategy. Now, this video is not about how to actually trade. This video is just about how to understand price, how to look at a chart and understand what's going on. Later on, we're going to be talking about strategy. That's where you really define how you actually get in, how you get out, when you take profit, when it's time to cut the loss. All those different details, that's what people are really looking for. But without understanding this, every strategy is useless. You need to understand how to read a chart first, and then you build your strategy on top. All right, so I hope this was helpful. If you enjoyed this video, if you found it useful, make sure to give it a like. Make sure to hit that subscribe button so you can see more of my videos. And if you have any questions or comments, I would love to see them, and I'll make sure to answer all of them. So post them below, and I will see you on the next one.